Today we are diving into unfair claims settlement practices for the national portion of the life insurance exam. This topic represents the ethical and legal guardrails that prevent insurance companies from taking advantage of policyholders during the most vulnerable time, which is the claims process. On your exam, you are likely to see scenario-based questions where an adjuster or a company representative behaves in a way that seems slightly off, and you must identify the specific violation. One of the most common violations is misrepresenting pertinent facts or policy provisions. This happens when an insurer tells a beneficiary that a certain death benefit is excluded under a specific rider when the language in the policy actually provides coverage. The exam often frames this as an attempt to settle a claim for less than what is reasonably owed. Another critical practice to recognize is the failure to acknowledge and act reasonably promptly upon communications with respect to claims. If a beneficiary submits a proof of loss and the company ignores it for weeks without any standard acknowledgement, they're in violation of the Model Act. You must also watch for the trap of denying a claim without a reasonable investigation. An insurer cannot simply look at a death certificate and issue a denial based on a hunch about a pre-existing condition. They must conduct a thorough search of medical records and gather evidence before making a final determination. Similarly, if an insurer has already determined that liability is clear, but they intentionally delay payment to hold on to the funds for investment income, they are engaging in an unfair trade practice. This leads us to the concept of compelling litigation through lowball offers. This is a classic exam question where the insurer offers an amount that is significantly less than the policy limit, forcing the claimant to hire an attorney and sue the company just to get the amount they were originally entitled to. The regulators view this as a predatory tactic designed to wear down the consumer. You must also be aware of the requirement to provide a prompt and reasonable explanation for a claim denial. It is not enough to send a letter stating that a claim is rejected. The company must cite the specific policy language or factual basis for that decision. To remember these prohibited actions for the exam, you can use the mnemonic MAD-CAP, which stands for misrepresentation, acknowledgement failure, denial without investigation, compelling litigation, affirming liability delays, and prompt explanation failure. When you see a question about claims handling, remember that the burden of proof for the denial lies with the insurer, and they must act in good faith throughout the entire life cycle of the claim. The exam will try to trick you by suggesting that a company can delay payment if they are investigating fraud, but even in those cases, they must provide updates and follow specific timelines. If the question describes an insurer failing to adopt and implement reasonable standards for the prompt investigation of claims, that is also a red flag. Every company must have a written manual and standardized procedures to ensure all policyholders are treated fairly, regardless of the claim size. If you encounter a scenario where an insurer tries to settle a claim based on an application that was altered without the knowledge of the insured, you are looking at another major violation. Focus on the theme of transparency and speed, as these are the two pillars that most of these laws are built upon. For the exam, keep in mind that these rules apply not just to the initial claim, but to the entire negotiation process. For instance, an insurer cannot try to settle a claim for an amount that appears unreasonable based on the advertising material that accompanied the original application. They also cannot delay a claim payment by requiring a claimant to submit both a formal proof of loss form and a subsequent periodic report that essentially asks for the same information just to stall for time. This is often called duplicative reporting, and it is a common trick used in exam questions to identify bad faith practices. Another point of confusion on the exam involves the time frame for payment after liability is established. While specific days vary by state, the national portion focuses on the concept of reasonable time. If the insurer knows they owe the money, they must pay it. Always look for actions that prioritize company profits over the contractual obligations to the beneficiary. By memorizing these specific prohibited acts, you will be well prepared to spot the incorrect behavior and choose the right answer on test day.